Omotola Abimbola from Afrinvest, one of the investment analysts, is live here in the studios this morning to talk us through that. Good morning. It's good to have you.
Good morning, boss.
I hope you had a nice weekend. Let's talk about that. But this is one news that is it particularly out of the blues?
Well, I would say so because we had no inkling to it until the minister came out during the week to announce it. But then I would say it's a very good move.
How come none of us heard about it? That's amazing.
Well,
government knows how to keep secrets.
Maybe they don't have to, but...
We didn't see it coming.
We never saw it coming. But it's still a very good move, I would say, because one of the major problems of the current administration is the high level of debt servicing costs. If you look at the 2016, actual expenditure outlay, you will see that debt servicing took up over 60% of government's revenue, which is quite significant. And as we go on, we are seeing that the fiscal space to continue taking on more leverage is being squeezed out by the high servicing cost. So what they hope to achieve here is to reduce that servicing cost so that they can unlock more borrowing potential to continue to finance year-on-year government expenditure.
Let's give this administration some pass mark in terms of, it looks like the administration is listening. Everyone seems to be talking about high costs of the level of debt to start with. Then the cost of servicing, then the tenor.
Correct.
Then the private sector, which the central bank uses every opportunity to knock the federal government on the head, that you're crowding out the private sector from borrowing because you're paying almost 20% on 30-day, 90-day treasury bills. Where is the market for everyone else? So it looks like, from all indications, this administration is saying, okay, hold on every second. We understand you. We understand what you're saying. How do we get this done? By restructuring treasury bills?
Essentially, what they're planning to do is a refinancing of existing debt obligation. If you look at the structure of Nigeria's federal government debt at the moment, you will see that about 25% of the existing obligation is via treasury bills instruments, which are short-term tenured, less than 365 days, and very expensive as well. At the moment, the federal government borrows from the private sector, from banks generally, from treasuries, pension funds, banks, insurance companies, etc., at a rate higher than 18% for 65-day borrowing in the treasury bills market. And that's about 25% of existing federal government debt. Meanwhile, we have external debt, which constitutes less than 20% of total debt outstanding, and then you can borrow at a much more cheaper rate of between 7 to 8%, depending on the tenor that you are borrowing from. So what they are doing now is a restructuring of the existing, refinancing rather, of existing, debt obligations, such that they can go to international capital markets where there is a high appetite for high-yield emerging markets bond, then borrow at a rate of between 6 to 7%, and then come back to the local markets and retire existing treasury bills using the borrowings from the international capital markets. Essentially, it's a refinancing operation. Borrow from somewhere else at a cheaper rate, and then come to your domestic market and pay down on the maturing treasury bills, in order to lower borrowing costs of the federal government, and perhaps restructure the exposure, or rather, restructure the distribution or the composition of domestic public debt. We've crunched the numbers, and we found out that the federal government goes ahead and raises $3 billion from international capital markets to do the financing. They'll be able to reduce the contribution of treasury bills to total debt outstanding by up to 5 percentage points. So that's bringing down the ratio from 25% of total debt to around 20% of total debt. And then, on the other hand, increase the contribution of external debt to total debt by the same margin, 5%, from 20% now to 25%, which we think is more optimal.
Yes, it's a very smart move. And I said this yesterday, because if you earn in dollars, with a naira devaluation already, that's more naira on the table. And the federal government can say, okay, everybody, thank you very much. Take your money. We've borrowed from you because it's a very smart business, very smart businesses. But one thing is this, of course, there's going to be a bit of downside to that because of dollar. Sometimes the way the dollar behaves.
Exactly.
It could be a little bit worrying for everyone holding that currency. It could be really hot.
It could be. I agree with you totally because one of the major risks of borrowing in foreign currency is that when there is a volatility, or rather a depreciation or devaluation of your exchange rates, then it means that you have to raise more naira revenue to pay down on those debts. So essentially, the success of this plan will depend on Nigeria being able to sustain the current trend of improved revenue from crude oil exports. Because if you're able to grow our revenue from crude oil exports, then there wouldn't be any significant, foreign exchange mismatch when you want to pay down on your external debt. So I believe that there is a risk to it in terms of the FX volatility risk. But if Nigeria could just manage to be able to sustain crude oil production at this level, and perhaps we see, oil prices stabilizing in the current region, it might not be a significant risk. It might not be.
The guys on the street have to worry that this is additional $3 billion to our debt portfolio. Is it any cause for worry for the common man who will be listening to us and see what is going on and say, oh, looks like Nigeria is borrowing more, and then there's more for us to pay in the years to come?
Well, fortunately for Nigeria, we're a bit under-leveraged when it comes to external borrowing. Nigeria's total external debt as of today is $13 billion. And out of that, about 70% of that is majorly from multilateral lending partners like the World Bank, the Japanese, multilateral and bilateral in nature, from World Bank, the Japanese JICA, the AFDB and the likes. So these are more longer tenured, instruments that are offered at concessionary rates, between 2 to 4%. Nigeria's real, borrowing from the capital markets is less than $4 billion, and that's our outstanding Eurobond obligation. So taking the figure from $4 billion to $7.7 billion might not be too significant at the moment and probably not be a cause for worry, But then, like I mentioned, what happens to the crude oil markets and what happens to Nigeria's crude oil exports and earnings will be a risk to factor in, going forward.
Okay. And when this hits the system, in terms of how banks, PFAs, mutual funds, and others, those of you who have portfolios attached to the treasury bills as part of your component, how will you react to this development?
I would say that is a bit undecided as of now, because, like I mentioned, the plan for refinancing is a very good fiscal plan, but it might not extend completely to monetary policy, because lowering interest rates in the economy, the central bank seems to have much more policy instruments to effect that than the federal government. So even if the federal government, reducing their borrowings from the treasury bills market, central bank will just come up and increase their homo auction, and then they take out all the money back. So essentially, how it's going to affect the yield curve or the level of private sector lending by commercial banks depends on what the central bank's response is, right? If we decided that we still have to maintain the cost of policy tightening, then all they need to do is just ramp up on OMO bills issuance and offset the additional liquidity to come from the refinancing of federal government treasury bills obligation. So we believe that for this plan to work in terms of reducing the interest rates in the economy and allowing for more private sector lending, this federal government needs to work with the Central Bank of Nigeria to ensure that they have an harmonized view on this topic.
Harmonized view on this particular topic. But again, treasury bills, whether it comes in all this, it seems to be just a financial markets conversation. So most likely I'm going to have a few folks asking questions. How do these trickle down into the real economy? This is just looks like helping you guys downtown make more money.
It might appear so, but how would affect the common man on the streets also depends on how the central bank responds. If you go, private sector lending over the past 2 years, it has been restricted in real terms. If you remove the currency devaluation impacts on private sector lending, it's been sort of muted in the past 3 years due to elevated risk in the economy, so which has made banks a little bit, less aggressive in terms of giving out loans to people. But of course, if federal government reduces their level of borrowing in treasury bills market, it will mean that there is much more money available for banks to lend to the private sector, both individuals, businesses, etc., and that could spur growth further in the economy. But the central bank has to be taken into consideration when trying to factor in the implication for the financial market, because they have much more policy tools which they can use to affect the yield curve and interest rate level in the economy than the fiscal guys can do. So if the federal government eventually succeeds in this plan, because it's going to the National Assembly and they have to approve of it, But if they're able to approve of it, and in the end are able to do that refinancing, central bank could still, alter the impact on the financial markets by just increasing the volume of mop-ups in the economy. So it has to be a very joint effort by both the central bank and the Federal Ministry of Finance to ensure that the impacts of this actually felt by the common man on the streets in terms of, lower borrowing costs.
In terms of who will be part of the new game? The usual guys? Well, banks and PFAs and all that invest in treasury bills. This refinancing and repackaging, who are the guys I need to keep my eyes on?
Probably commercial banks and the PFAs. Because if you look at the half-year earnings trickling in for most commercial banks now, you will see that it is a loss driven by higher interest income, particularly coming from treasury bills. Zenith Bank's results came out yesterday, their half-year numbers, and you saw that their gross earnings jumped by over 70%. And a major factor that led to that, improvement in gross earnings was because of the interest income being earned on treasury bills. It's doubled from about 25 billion naira in half-year 2016 to over 50 billion naira in half-year 2017. So if this plan goes ahead, and the federal government reduces their level of borrowing in the treasury bills market, right, and lower their borrowing cost, there will be a consequential impact on the yield on assets, of commercial banks and of PFAs. But in the end, that may probably spur them to actually look for opportunities in the real sector and extend credits there in order to ensure that their yield on assets still remains at the current level. So it could be a benefit to the main street, that is to the economy, to the real sector in general, although it could be a drag on the financial markets.
In particular, the banks?
Particularly the banks, exactly.
Particularly because you're taking a bit of their low-hanging fruits away from them.
Correct. Perhaps if you look at the asset distribution over the last 2 years, most have been increasing on their allocation to investment securities and be cutting down on real growth in loans. Last year we saw loans grow, but that was majorly due to the depreciation of the currency. Because banks have about 30% of their loans in foreign currency. So when the naira weakens, there will be a nominal growth in loans. But if you're looking at the numbers in real terms, they've actually been cutting down on their lending to the real sector and been, channeling the money to the low-hanging fruits present in the financial market, meaning treasury bills. So if there is a reversal in this, it will have an impact on their earnings going forward. But that could also perhaps spur them to take more interest in the real sector, by giving out money to businesses and individuals.
So technically, it's a good one here. Is it anything of this nature likely to happen in the bond market?
Yeah, perhaps so, and maybe not so, because the instrument the federal government is targeting right now is mainly treasury bills. And if you look at the yield curve at the moment, you will see that we have elevated yields at the short end of the yield curve, mainly for treasury bills, while bond yields are a bit lower. But seeing bond yield, on average trending between 16% to 16.5% over the past 2 years. But treasury bills yield have been a lot higher because of the aggressive stance of the central bank in the treasury bills, in the homo market particularly, through their frequent homo mop, which has been squeezing liquidity in the financial markets. So perhaps we might not see a significant impact in the bond market for now.
It's going to be quiet. Thank you, Omotola, Abimbola. Thanks for putting your analyst team perspective into that. You have a great weekend.
Yes,
and next week we'll have a lot more to discuss from Afrinvest investment analyst Omotola Abimbola.